Welcome to Tax Breaks. I'm your host, Kelly Phillips Erb. I'm a senior writer for Forbes, and you may have seen me around the web as Tax Girl. I'm also a tax attorney, and I work with taxpayers and tax professionals like you every day. There's a lot to talk about, so let's get started. This week, the lights are still on in D.C., more shakeups at IRS, increased financial scrutiny from the government, reading your tax transcripts, investing your IRA in gold, tax trivia, tax filing deadlines, and more. As the deadline loomed, Congress voted to avoid a government shutdown. That's after the Democrats' leader, Senator Chuck Schumer, a Democrat out of New York, voted yes on a procedure to advance a spending vote. The Senate vote follows an earlier vote in the House to fund the government through September 30th, 2025. The final House vote was 217 to 213, with only one Republican, Thomas Massie of Kentucky, voting no, and only one Democrat, Jared Golden of Maine, voting yes. The Congressional Budget Office, or CBO, estimates that the bill will cost $1.6 trillion. That breaks down into $893 billion for defense and $708 billion for non-defense spending. The Continuing Resolution, or CR, largely mirrors the previous year's funding measures, while increasing military spending by $6 billion and cutting $13 billion in non-defense spending. It also includes a boost in Immigration and Customs Enforcement, or ICE, deportation operations, and claws back $20.2 billion of IRS funding. This is in addition to earlier cuts. Cuts to the IRS budget weren't the only issues for the tax agency this week. Weeks after the acting IRS commissioner departed, another high-profile staffer is leaving. Acting Chief Counsel William Paul has been removed and is expected to be replaced by Andrew DeMello. Paul was reportedly demoted because he refused to cooperate with Elon Musk's Department of Government Efficiency, or DOGE, as DOGE representatives allegedly sought to share taxpayer information with other federal agencies. The Chief Counsel, a position that dates back to 1866, is the chief legal advisor to the IRS Commissioner on all matters related to the interpretation, administration, and enforcement of tax laws and other legal issues. Attorneys in the Chief Counsel's office serve as lawyers for the IRS. They provide IRS and taxpayers with guidance on interpreting federal tax laws and represent the IRS in litigation matters, typically in tax court. Before recent personnel counts, the Chief Counsel organization had approximately 2,600 employees. Other IRS cuts are still in the news. To date, approximately 7,000 probationary employees in the IRS have been fired. While probationary employees are often recent hires, meaning within the last 1 to 2 years, they don't have to be. Those who have been serving for years but were recently moved or promoted into a new position also qualify as probationary. However, a U.S. district judge in California called the terminations of probationary employees unlawful and ordered their reinstatement. The order impacts all fired probationary employees from 6 federal agencies, including the U.S. Treasury, the home of the IRS. That relief for IRS employees may be short-lived, as reports suggest that the IRS will make additional dramatic cuts to its workforce. The exact numbers, estimates are between 20 and 50%, and the timing of those cuts have not been confirmed. But even as cuts are happening, tax season is rolling on. IRS data from the 5th week of the tax filing season, the week ending February 28, 2025, continues to suggest that taxpayers are not excited about filing this tax season. Numbers for tax filing and processing of tax returns remain low, a mark that has not changed since the beginning of the filing season. While the IRS may be slowing down, the Treasury's Financial Crimes Enforcement Network, or FinCEN, may be becoming busier. The Trump administration is seeking more information about financial transactions for those who live or do business in one of 30 zip codes in California and Texas near the border. Beginning in April, FinCEN will require money service businesses in those zip codes to report those Americans who spend more than $200 in cash or cash equivalent on items like money orders and traveler's checks. That's a dramatic expansion of the standard $10,000 cash reporting rule. The MSB designation, again, that's for money service businesses, includes businesses like check cashing services, sellers of traveler's checks or money orders, and money transmitters. The increased reporting rule is in sharp contrast to eliminate other reporting requirements. The House of Representatives has voted to repeal a Biden-era reporting requirement focused on decentralized finance, or DeFi. The bill reverses the DeFi broker rule, published by the Treasury in December 2024. The rule created reporting requirements for trading front-end service providers that work directly with users on digital asset transactions. DeFi refers to peer-to-peer financial services on the blockchain. In simple terms, it's crypto and digital currency without the banks, financial service companies, or other middlemen. DeFi brokers are a little more challenging to define, as stakeholders pointed out after the final regulations were made public. Notably, DeFi brokers are decentralized. It's right there in the name, and as such, do not collect information from users that would be needed to comply with the rule. The vote now moves to the Senate, which voted earlier to overturn the rule. Procedurally, however, the vote has to happen again to line up with the House vote. As you can tell, there's a lot happening in the tax and budget space right now. We're doing our best to sort out fact from speculation as we aim to keep you informed. I know it can be a bit overwhelming. Having so much happen during tax season keeps tax professionals and taxpayers on edge. I hope that you'll take a break, go on a long walk, enjoy a Guinness and some corned beef and cabbage, or do a little early spring gardening. Feel free to drop me a note and let me know how you're keeping sane during the tax season. Now let's answer a taxpayer question. This week, a reader asked, "My tax refund is late. When I checked my transcript, there was a code 570. Am I being audited?" So here's my answer. I generally encourage taxpayers to take advantage of their IRS online account, including taking a peek at their transcript when appropriate. That said, while IRS transcripts can be helpful, they can also be complicated if you're not sure what you're looking at. That includes transcript codes, or TC, on your account. One of those codes is TC 570 or TC 570, which is a catch-all. It simply means that there's a delay in processing your tax return. You'll note that it's typically accompanied by the words additional account action pending. The code TC 570 doesn't necessarily mean that you did anything wrong. Importantly, you don't need to do anything further until you hear from the IRS. There's no need to call and spend time on hold, for example. The IRS may send you a letter asking for more information. This is often when testing indicates that there might be fraud on the account. When that happens, the account is flagged and the IRS stops processing your return. The IRS may send you a letter asking for more information. This is often when testing indicates that there might be fraud on the account. When that happens, the account is flagged and the IRS stops processing your return. They'll usually send you a letter with information and further instructions. If identity theft is suspected, you'll typically receive a letter 5071C asking you to verify your identity. If so, follow the instructions found in that letter. TC 570 could also be triggered for other reasons, like questions about credits that you claimed on your return or income that you reported. If that's the case, expect a letter asking for more information. If you receive a letter from the IRS, it's important to respond promptly. If you don't, your tax return could be further delayed. Once the IRS has resolved the issue, you may see TC 571. That's the thumbs up. If you see TC 846 after that, that means that the IRS has finally issued your tax refund. With that, I don't recommend using the transcript tool to check on your refund. The fastest, best way to get information about your refund is to use the Where's My Refund tool, available on irs.gov and also as an app. Refund status is typically available within 24 hours after the IRS receives your e-filed return for the current tax year, or 4 weeks after mailing your paper tax return. And remember, the IRS only updates the tool once a day, usually overnight, so there's no benefit to checking throughout the day. If you have a tax question or matter that you think we should cover in the next episode, let us know. You'll find more information in the show notes. Of course, if you follow me on Forbes, you know that I love looking at statistics and enjoy a good chart or map. This week, I'm focused on tax refunds. The IRS may have your money. The tax agency says that more than $1 billion in outstanding tax refunds remains unclaimed from the 2021 tax year. The agency estimates that more than 1.1 million taxpayers might have qualified for a tax refund, but did not file a federal income tax return in order to claim it. If you are due a tax refund, typically you must file a federal income tax return to get your money. Taxpayers usually have 3 years to file and claim their tax refunds. If you don't file within those 3 years, the money becomes the property of the U.S. Treasury. The 3-year window for filing your 2021 tax return would close on April 15, 2025. The IRS estimated how many people in each state might be entitled to a tax refund based on their data. Taxpayers in New York, Pennsylvania, Rhode Island, Massachusetts, and Illinois are expected to have the highest median potential refund. California, Idaho, New Jersey, Minnesota, and Montana taxpayers are expected to have the lowest refunds. Not surprisingly, taxpayers in the most populated states are missing out the most. More than 100,000 taxpayers in each of California and Texas may be entitled to a tax refund for the 2021 tax year, followed by New York, Florida, and Pennsylvania. Taxpayers in less populated states may be missing out too, with thousands of taxpayers in Wyoming, North Dakota, Vermont, South Dakota, and the District of Columbia also reporting potentially unclaimed refunds. If you think you're due a tax refund, time is running out to claim your money. Now it's time for a little tax trivia. The IRS expects to receive more than 140 million individual tax returns for the tax year 2024 by the Tuesday, April 15 deadline. In the first year of the modern federal income tax system, those tax returns received in 1914. Approximately how many returns did the IRS receive? Here are your choices. A, 350,000, B, 750,000, C, 1.5 million, D, 3 million. I'll give you a minute. The answer is A, 350,000. By 1945, IRS was processing 50 million individual tax returns annually. In 2024, the IRS received 139,137,000 individual income tax returns by tax day and 164,473,000 by year end. Now it's time for a deeper dive, and it's a look at gold and retirement accounts. The markets may be down, but the price of gold is up. Over the past 5 years, the price of gold has increased by more than 78%. With each bar of gold bullion costing more than $1 million. So does that make precious metals a good choice for your IRA? The tax code allows certain precious metals to be held in an IRA under Section 408M3 of the tax code. To qualify, gold must meet specific purity standards, with bullion bars and coins typically needing to be at least 99.5% pure. There are other rules. This is tax law after all. For example, the gold must be stored in an IRS-approved depository. That means personal storage of gold, such as at home or in a safe, is prohibited. And not all gold products qualify. Collectible coins, for example, are usually not permitted. If you do not want to have physical ownership of the bullion, your IRA can buy shares of an exchange-traded fund, or ETF, that follows the value of a precious metal. That's according to Private Letter Ruling 2007-3202. The bottom line, you can invest in some non-traditional assets like precious metals or ETFs in your IRA. Now, for something a little more brief, some quick tax and accounting newsmakers. April 1st will be here soon, and it's the deadline for retirees who turned 73 in 2024 to begin receiving the required minimum distributions, or RMDs, from IRAs, 401ks, and other retirement plans. Under a special rule, IRA owners and participants born after December 31st, 1950, and who turned 73 in 2024 can delay their first required minimum distribution, or RMD, until April 1st, 2025. The April 1st deadline is for the first year only. For subsequent years, the distribution is due by December 31st. Further, taxpayers receiving their first required minimum distribution, or RMD, for 2024 in 2025, that's by that April 1st deadline, must take out a second RMD for 2025 by December 1st, 2025. And a post-election boost in business executives' optimism about the U.S. economy has moderated, declining from a more than 3-year high of 67% last quarter to 47% this quarter. The American Institute of CPAs, or AICPA, and the Chartered Institute of Management Accountants, CMIA, Economic Outlook Survey found these results. The shift reflects growing concerns about inflation and tariffs, according to the survey, which polls chief executive officers, chief financial officers, controllers, and other certified public accountants in U.S. companies who hold executive and senior management accounting roles. And that's a wrap. Thanks to all of you who continue to watch, comment, and share the show. I'd love to know what you thought of this episode. You can send an email with your feedback to kerb@forbes.com. And if you like it, please share. You can also find a link to the audio of each episode on Forbes.com. Thanks for listening, because paying taxes is painful, but hearing about them shouldn't have to be.